Hi, and good day everyone. Today, we will be presenting on the recognition and derecognition process based on the conceptual framework. This topic explains how items are included in financial statements and why it is important for financial reporting.
So, what is recognition? Recognition refers to the process of including an item in the financial statements. For an item to be recognized, it must meet the definition of elements like assets or liabilities and provide useful information. It is represented both in words and numbers and included in the totals of the financial statements. For example, if a company buys a machine, it will recognize it as an asset in the financial statements. Next, the purpose of recognition. The purpose of recognition is to provide relevant financial information to users. It helps represent key elements such as assets, liabilities, equity, income, and expenses. This allows users to better understand a company's financial position and performance. For instance, recognizing a loan as a liability helps investors understand that the company has an obligation to repay money. In terms of financial position, recognition involves assets, liabilities, and equity. An asset or liability is recognized only if it meets the definition and provides useful information to users. As example, if a company owns cash, it is recognized as an asset. If it owes money to suppliers, it is recognized as a liability. For financial performance, recognition focuses on income and expenses. These are based on changes in assets and liabilities. For example, an increase in assets or a decrease in liabilities results in income, while the opposite results in expenses. As the link between statements, the financial position and financial performance are closely linked. Changes in equity act as the connection between the balance sheet and income statement. Also, contributions from owners and distributions to owners affect equity. As example, if a company earns profit, its equity increases. This shows how the income statement is linked to the balance sheet. There are two main criteria for recognition. First, the item must meet the definition of an element. Second, it must provide relevant information and be a faithful representation. It also happened when a company will only recognize an asset like inventory if it can measure its value reliably and it is useful to users. Next, what is relevance? Relevance means the information can influence decision-making. It should have predictive or confirmatory value. We also consider factors like probability and measurement uncertainty when determining relevance. As example, the information about a company's profit is relevant because investors use it to decide whether to invest or not. So, even if the probability of an inflow or outflow is low, the item may still be recognized. This depends on whether the information is still relevant and useful to users. As example, a company may still disclose or recognize a lawsuit, even if the chance of losing is low, if it is important for users to know.
Faithful representation means financial information must accurately reflect the real economic situation. When we recognize assets or liabilities, it should not only be relevant but also truly represent what is happening, including income, expenses, and equity changes. However, this can be affected by measurement uncertainty. This slide explains measurement uncertainty. Assets and liabilities must be measured, but in many cases, we rely on estimates, which create uncertainty. These estimates are still useful as long as they are clearly explained. However, when uncertainty is too high, such as when outcomes vary widely or depend heavily on assumptions, the reliability becomes questionable. So, accountants must decide whether to use the uncertain estimate with proper disclosure, or choose another measurement that is less uncertain but may be slightly less relevant. In some extreme situations, all possible measurements are too uncertain. When this happens, the asset or liability should not be recognized because it would not provide useful information. However, if the item is recognized, companies must disclose all uncertainties, including uncertainty about existence, measurement, and future outcomes like timing and amount. Faithful representation is not just about numbers. It also includes how information is presented and disclosed. We must consider the impact on profit, avoid accounting mismatch, and ensure proper disclosure so users can understand the full picture. Derecognition means removing an asset or liability from financial statements. For assets, this happens when the company loses control. For liabilities, it happens when there is no longer a present obligation. The main objective is to ensure the financial statements accurately show what remains and what has changed after a transaction. To do this, companies remove transferred or fulfilled items and recognize any resulting income or expenses. However, derecognition is not always appropriate. If the company still has control, risks, or benefits, the asset should still be recognized. In special cases like repurchase agreements, the transaction is treated as a loan instead of derecognition. For contract modifications, we must assess whether rights are removed, added, or significantly changed. In major changes, the old asset may be replaced. In conclusion, derecognition focuses on the true economic substance, not just the legal form.